So one of the first things I wanted to cover was the reason that I choose for myself as well as my clients choose residential property as the vehicle to deliver the financial security and passive income that we need to live the lifestyle that we deserve over the long term. And one of the best ways to explain this is through the use of data. So I've asked my in-house research team to prepare some historical data across Sydney, Melbourne and Brisbane markets showing the long-term price growth of residential property in these markets. Yes, there's other markets out there that we look at, and throughout this course, I'll be sharing some of the resources that you can use to have a look in those markets. But for the purposes of this, we're going to focus on the Sydney, Melbourne and Brisbane markets. So having a look at Sydney, over the last 20 years, we've experienced quite considerable price growth. As you can see in the period between 1998 and 2007, across houses and apartments, houses had a 7.88% price growth, apartments 6.83%, and slightly lower in the period between 2007 through to 2018, with about 6.62% growth for houses and 6.82% growth for apartments. Melbourne, a similar story. Between the period of 1998 to 2007, there was quite significant growth for both houses and apartments. And one of the reasons for this, it was coming off a significantly lower base than Sydney was in 1998. A little bit slower between 2007 and 2018 at 5.7 and 4.5 respectively. However, you can see across these two major markets, consistently over time, over the long run, property prices have gone up, and I'm sure you're all well aware of this. Again, similar story to Melbourne in Brisbane, where there was significant growth between 1998 and 2007. In Brisbane's case, there's been a significant flat line between 2007 to 2018. However, if we look at the property market as a whole, over 20 years in the eastern states, Sydney, Melbourne and Brisbane, across both apartments and houses, they've grown at 7.17%, which equates to, on average, property doubling every 10 years. Now, has this been consistent over every 10-year period that we can choose between Sydney, Melbourne and Brisbane? Of course not. As we saw, there's going to be flat spots and sometimes even recessions or declines in prices. However, over the long term, these are the averages and we expect those to continue. And why do we expect those to continue? Because a lot of people are out there saying, hey, property prices in Australia can't continue to grow at the rate that they've been growing. Well, let's look at the data rather than listening to the hype. In 1997, the ABS predicted that our 2051 population would be 26.4 million people. Fast forward a few years, in 2018, we've already reached a population of 25 million. What does that mean? That means we're pretty much 30 years ahead of schedule in our population growth. Now, in terms of supply, all these people need a place to live, and we were predicting we were only going to reach this number in 2051. Does that mean that there's more people coming to Australia than there is supply of housing? And in a simple supply and demand perspective, does that mean there'll be continued demand for property within Australia? Of course it does. In 2012, the ABS predicted that in our 2061 population was going to be somewhere between 37 to 48 million. Now, how close that's going to be to reality is anyone's guess. But the point I want you all to take out of this is that population in Australia is growing much faster than we predicted. In fact, Australia is the fastest growing developed country in the world, growing at 1.6% per annum. Where are all these people coming from? the interesting thing that we found out when we partnered with well-renowned social demographer Mark McCrindle was that the population growth was not actually, or the majority of the population growth was not actually coming from Australia's natural increase, which is the births minus the deaths. However, the main part of the population growth, 58% of the population growth, was actually coming from net overseas migration. So arrivals less departures, and that's how we calculate net overseas migration. Now, where do the people that are migrating to Australia want to live? Well, once again, our research team turned to the ABS for the answer. And they found that 83% of overseas born population live in capital cities. So this really dispels the theory that, hey, Australia is such a big country with only 25 million people in it. All of the population that's coming to Australia, the majority of the population, are trying to live within our capital cities. And our capital cities are struggling in terms of their rates of growth in order to keep up with this population demand in terms of the supply of housing. And this imbalance between demand and supply is what's going to cause our property prices to continue to appreciate, just as we've seen over the last 20 years. Now, a lot of the time I get questions from people that say, hey, why don't I just go and invest in shares? Why don't I go instead of property? And this is an example that I generally show them to show the power of property in terms of boosting their net worth. The other time I use this example from a personal story was when I was learning about property investment from my parents, because they came from a generation that believed in buying a property, whether it be investment or a place to live in, and paying off the debt as quickly as possible, because in their mindset, debt was a bad thing. They didn't understand the difference between good debt and bad debt. So I came up with this example to show the power of leverage in order to calm them down and help them to understand exactly the best way to invest in property. So the example goes like this. Let's say that there was two people and they're both looking to purchase a $1 million investment property. Now, person number one is a very rich person. They're able to pay $1 million in cash for their investment property. And because they're a very astute investor, they get a 7% capital gain, meaning the property grows by 7% in the first year, which means that at the end of the first year, it's worth $70,000 more than what they paid for it. And because they picked such a good property, they have people literally queuing up to rent this property. So they're able to charge a premium to rent the property out. So in this example, we're going to assume that they get a 6% yield, or 6% of the property value is paid in rent, making them $60,000 in their first year. And because they pay cash for the property, they don't have to pay any interest back to the bank. So all things being equal, we can assume that person one gets a profit of $130,000, which is not too bad. Now, person number two, he's not quite as rich as person number one, but he still wants to buy his $1 million property. So in this example, he puts a 20% or $200,000 deposit down on this property. But person two is not as lucky as person number one and picks a worse property. So they're only able to get a 5.5% capital gain of about $55,000. And because it's not as good of a property, they're only able to get a 4.5% yield, making them $45,000. But because they had to borrow money from the bank, they have to pay interest on the $800,000 that they had to borrow. So in this example, we're going to assume a 5% interest rate. So it costs them $40,000 a year to hold on to this property. So at the end of it all, person number two makes a profit of only $60,000 against person number one, who makes a profit of $130,000. So the question I ask people that are trying to consider shares, or people that are a little bit of an older mindset that think that borrowing is a bad thing, I say, which person or which investor would you rather be? Now, often the answer I get is person number one, because they make more money. But what most people fail to see or consider is actually the returns on investment that each person is going to get. Now, if you think about it, person number one made $130,000, but they invested $1 million. So that means they get a return on their investment of 13%. But person number two made a profit of $60,000, but they only invested, after interest was paid to the bank, $200,000, meaning they've got a return on their investment of 30%, even though they picked a worse property than person number one. Now, this example is designed to show you the power of leverage and using other people's money in order to amplify your investing efforts. And the other key insight that I get out of this example is, if you really think about it, in person two's case, the bank is willing to lend 80% of the money in order to enable person two to buy their investment property, which means that the bank is taking on 80% of the risk of person number two's investment. However, the bank is also giving, in terms of capital gain, for the cost of a little bit of interest, 100% of the returns to person number two. Now, if you could take on only 20% of the risk and get 100% of the gains, does that sound like a good deal to you? To me, for sure it does. And the other thing is, with banks being so sophisticated in the way they assess lending criteria and how protective they are over their money, do you think that the bank's going to be a better assessor of risk than you and I? I think so. But yet they're still willing to take on 80% or more in some cases of the risk of investing in property and still allow people to maintain 100% of the profit. So the question is, why doesn't everyone invest in residential property, that is? Well, again, we look at the statistics. If you had to have a bit of a guess as to the number or the percentage of Australians owning 1 to 2 properties outside of their family home, what would you guess? The answer is 7.4%. But the really interesting statistic that we quite often look at is the percentage of Australians owning 4 or more properties outside their family home. Now, why is 4 or more particularly important to us? Generally, 4 or more properties outside of a family home is the amount of net assets that are going to be required to deliver the level of passive income most Australians choose to need in their retirement. And as you can guess, the answer is 0.32%. And why is there such a gap? Well, there's a whole raft of reasons, but one of the things is people start out on their investment journey buying their 1 or 2 properties outside their family home because it's maybe, in inverted commas, the right thing to do. But because they don't actually begin with the end in mind and put in place a team of support around them in order to help them on their journey, life tends to get in the way. Negative media headlines, a friend at a barbecue says, hey, it's a terrible time to hold on the property, why don't you sell? And all of these reasons and roadblocks that come up in people's lives, if they don't have the right reason, the goal, beginning with the end in mind, as well as the right support team around them in order to support them when things go wrong. Because just like anything in life, it's very easy to paint property investment as all roses. But the reality is there's always going to be hurdles to overcome. Things like tenants moving out, interest rates going up, all these sorts of factors. You need that support team around you in order to hold on to the properties for long enough to allow them to do the hard work for you and deliver the amount of passive income that you deserve in your retirement.